Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Today on the show, we are going to put the spotlight on real estate investment trusts, or REITs as they're called. Now, why are we doing this? Well, this is in continuation with our conversation on the need to have adequate diversification in your portfolio. Last week, remember, we discussed how hybrid funds can help you achieve that. You can, in fact, catch the link for that episode. It's on the CNBC-TV18 YouTube homepage on the Let's Talk Money playlist, so make sure you go out there and search for it. Today, we will decode REITs as an investment class, their key characteristics, and the sort of returns that you can expect from this particular investment products. Now, joining me to help us decode all of this, Deepak Agrawal of Kotak Mahindra AMC, as well as Preeti Chheda of Mindspace Business Parks. Preeti is also a member of the executive committee of the Indian REIT Association, so she's speaking also for the industry as a whole. Lady and gentlemen, thank you very much for joining. It's great to have both of you on the show today. And there's so much to ask because this is almost like blue sky territory. We're always talking about equity funds, always talking about gold. REITs have been around for a while, Preeti, but they're still not mainstream in conversation. Why is that?
So, Surabhi, thank you for having me here. So REITs are relatively new. They just have a history of 6 years as compared to global markets, for example, US, where they have been for almost 6 decades.
Yeah.
We are not even 6 years old. So I think because it's new product and it's a little different than your conventional equity, I think that's the reason it's taken a little longer for people to really understand what the product is. If I were to just talk a little about the product, so it is a vehicle which is actually housing largely completed real estate and giving you the best of growth as well as appreciation. So this is one product which actually gives you regular income as well as a potential of growth with moderate risk, moderate return, because generally real estate assets which are housed in a REIT are largely completed, because that's SEBI REIT regulation also, where at least 80% of the assets have to be completed.
Okay.
And these assets are generally backed by underlying long-term lease contracts. So there is certainty of these cash flows also to a large extent.
So this is really important. You're already giving us lots of important information. As per regulation, you're saying that, first of all, 80% of the assets which are, being housed under a REIT, they must be constructed. They can't be under construction property, which has a lot of risk.
Correct.
And you're saying a lot of these assets must be, rental income generating, right? What proportion of the assets under a REIT?
80% has to be completed and rent generating.
And rent generating, okay.
It's only the 20% where you can do development.
Okay.
So therefore, from a risk mitigation perspective, this works very well for investors, because you have underlying cash flows which are coming out of the instrument.
No, absolutely. And straight away, what you highlighted takes away a lot of the risk associated with real estate as an investment class, for sure. Deepak, let me come to you as well for some opening thoughts over here. Preeti's point on risk is very well taken. What is the history of the 6-year history of REITs in India and the experience so far? What does it tell us, and why would you say that someone should consider REITs for their portfolio?
Thank you, Surabhi, for having me on the show. See, basically, investors are looking for diversification, and REITs give them one more option to diversify their portfolio. Traditionally, HNIs have been buying real estate, commercial real estate property directly. But when you buy the property directly, there are hassles with respect to, let's say, paying the stamp duty, property tax, maintaining the property. Or let's say, from time to time also, you need to search for tenants. So REIT gives a hassle-free option for HNIs to diversify their portfolio. At the same time, retail investors who are looking to diversify their portfolio, probably a 1 lakh, 5 lakh investment will be a very small amount to buy any commercial real estate property. So again, REIT is a opportunity for investors, both retail and HNI, to diversify their portfolio and take exposure to commercial real estate in a hassle-free way. Now, as Preeti mentioned, real estate REITs have first issue happened in 2019, and since then we have 4 listed REITs in the market. If I look from their issue price, cumulative capital gains are anywhere between 10 to 30%. And on a year-on-year basis, let's say whatever is the previous year price, what we see in a particular year, the prices are volatile and typically they trade in a range of plus minus 10% of the previous year prices. But for an investor who has bought them, let's say, in IPO over the course of last 2 to 3 years, or let's say 4 to 5 years, they have cumulatively earned a capital gain anywhere between 10 to 30%.
Okay, that's quite interesting, which actually brings us to the next layer of questions, which is understanding how do you make a return via REIT. So Deepak made the point on capital gains, but also let's remember that REIT essentially is pooling investments from a lot of different investors, right? Preeti, so it's like you, me, Deepak, all of us are, investing in REITs, and that REIT is using all that pooled money, and then of course, it's holding those assets.
Correct.
So help us understand both the parts, and there's rental income. So rental income is in return being distributed to all of us.
That's right.
And then there is the capital appreciation angle that Deepak referred to. So help us understand this.
Right. So REIT is in a way very similar to equity. They are listed on stock exchanges. So today anyone who wishes to invest can just go and buy one unit of a REIT, similar to you buy equity share. So it's as simple as that. Like all of us are listed on BSE, NSE, so you can just go and buy one unit. Now in terms of returns, because as I said, these are long-term assets and rent-generating asset. Now there could be different asset classes, we'll come to that, but because the rent is getting generated and the way a REIT is structured, the assets are all sitting in SPVs, which in a way, in a layman's language, it will be like subsidiaries of the REIT. REIT is listed, all the assets are sitting below. Now the rental income flows into the SPVs, which are the subsidiaries, and all the cash flows are upstream to the REIT in form of largely dividend, or it could be return of capital, or in form of interest. So these are three modes in which distributions are made by the SPVs to the REIT, and the REIT in turn distributes...
Return of capital, interest
and dividend.
And dividends, which these individual SPVs are giving to the parent REIT.
The parent REIT. And the REIT is a pass-through vehicle. So REIT just distributes all of them to the unit holders.
Okay.
And I think the beauty of the product is that the dividends which get distributed to the investors are not subject to any taxation, because REITs are subject to single level taxation. So all the dividend which comes to the unit holders, it's not subject to tax. And all REITs...
REIT dividends are tax-free.
Yes.
I'm just highlighting the headlines here, which investors always love. So that's an important aspect. We'll come back to taxation in more details. But just remember that dividends that you get from a REIT are tax-free in our hands, yours and mine. Yes, please continue, Preeti.
So this is, under the REIT regulation, the distributions have to be made every half year, but almost all REITs are distributing every quarter. So every quarter, you get this regular income. Deepak spoke of the returns. So if you look at our 6-year history, we've given returns anywhere between 12 to 13% overall annually. And if I have to dissect them, so half of that is coming by way of regular distributions and half is coming by way of capital appreciation.
Okay.
So if somebody would have invested in the REITs at the time
when you
of
say
IPO,
when you say capital appreciation, we understood the income distribution part, and those dividends are tax-free.
Yes.
When you say capital appreciation, you're talking about the appreciation in the price of that unit, the REIT unit itself, right?
So if somebody would have invested, say at the time of IPO, and continued to be invested, then you are getting 50% of the 12-13% return, which I spoke of, is coming from the capital appreciation, which is appreciation in the stock price, and the balance 50%. So say 6-7 is coming from distributions and 6-7 is coming from appreciation in the stock price, because these are inherent real estate asset, and real estate is an appreciating asset. We've seen all our assets keep appreciating because inflation, our rentals keep growing because they all, inflation moves up, the rentals move up. So the value of the assets also keeps increasing, and that in a way gets reflected in your price as well. And that's how you've seen the price moving. So this is one instrument, as I said, which has the combination of both regular income as well as growth.
Okay, that's quite interesting. Deepak, come in on this, and I want to get your estimates as well. Preeti was quoting sort of past trends and data, past 5-6 years. The average return has been in the range of 12 to 13% is what Preeti is saying, and this is before taxes.
This is before taxes.
Pre-tax. Yeah, pre-tax 12 to 13%. Now, if an investor is to consider this asset class, then, and I know that you can't extrapolate past returns in the future, but what is the kind of realistic return expectation that you would keep in mind while investing in REITs?
See, basically, since the listing of most of the REITs, currently they are trading at a premium of anywhere between 10 to 30%. So let's say on an average close to 15 to 20%. And if they have been in history for, let's say, last 4 years, they have generated a capital gain closer to 4% on an annualized basis. And as Preeti mentioned, the distribution is anywhere between 5.5 to 6.5%. So let's say if we assume 6% distribution every year, the cumulative returns which investors till now have got, who have bought in the IPO and are still holding, is anywhere between, let's say, 9 to 11%. Now, going ahead, we believe that the distribution is likely to be in the range of 5.5 to 6.5%. And let's say over a period of next 2-3 years, we are positive on REITs. We believe that the work from home, which happened during COVID time, is receding. People are coming back to office. GCCs are setting up offices in India, which will result in occupancy level going up. And gradually, we believe REITs will continue to do well. And let's say investors with, let's say, 2 to 3 year investment horizon can expect a 3 to 4% capital gains. And therefore, the total return, if an investor comes into a REIT with a return expectation of anywhere between 9 to 10% with, let's say, a 2 year plus investment horizon, I think that's a reasonable expectation.
And Deepak, this 9 to 10%, you're talking about effective return, net of tax.
Yeah, this is pre-tax. And let's say, because as the capital gain component is taxed at 12.5% if the REIT is held for more than 1 year. And since among the distribution component, dividend is tax-free, interest income is taxed as per your slab rate, and the repayment of capital is also more or less tax-free because the cumulative repayment of capital is less than the issue price. The effective post-tax return from a REIT would be higher than a traditional fixed income option. But on a pre-tax basis, my belief is that investors should invest in REIT with, let's say, a 2 year, 3 year investment horizon, expecting returns to be anywhere between 9 to 11%.
9 to 11% could be a reasonable expectation. But I just want to dive a little deeper in understanding the taxation aspects. And it's actually different types of taxation because the way you're earning your return from a REIT is also in different types of income. The heads of income are different. So just to get into those details as well, and to go over, what you said, Preeti, was that the dividend is tax-free. So that's not a problem at all.
That's right.
Then the REIT can also give me sort of distribution back in the form of interest income.
Yes.
When does that happen? I mean, do most REITs give dividends? Do they give interest income? And then interest income, I have to pay tax at my slab rate.
Correct.
So, you know, what is it, that choice that the REITs
make? So
generally
what happens is there are 3 forms of distribution which comes, as I said. So you get dividend, you get return of capital, and you also get interest. Dividend, as I said, is completely tax-free. Interest is taxable at each individual's marginal tax rate. But generally, and let me complete the return of capital. So what happens is, in a REIT structure, under the REIT regulation, you're supposed to distribute cash flows. So under the SEBI REIT regulation, 90% of your net distributable cash flows have to be given to the unit holders. And generally, there are a lot of non-cash items which sit in our P&L. So when we have to upstream that cash, obviously Companies Act says you can only upstream the PAT, okay? But there is more cash left in the SPVs, which needs to be upstreamed under the REIT regulation. So that, in a way, comes by way of interest or return of capital.
Now, so the other cash flows, the non-rental cash that,
it could be rental, for example, to give an example, say depreciation. That's a non-cash thing. So it gets deducted from your rental income and then you get to PAT. You distribute PAT by way of dividend, but the cash which is left, how do you upstream that? So these are mechanisms to upstream that. Now, in terms of taxation, interest is fully taxed. Return of capital is actually reduced from your cost of acquisition. So when you receive, you don't pay any tax. You reduce from your cost of acquisition. And when you sell the units of the REIT, whenever that be, 1 year, 2 year, 10 years, that's the time you actually land up paying capital gain tax because you've reduced your cost of acquisition. So in effect, you are paying capital gain tax on that when you sell the units. So dividend not taxable, return of capital not taxable when you receive, but reduced from your cost of acquisition. So you'll end up paying when you sell the units. Interest is fully taxed. By and large, if I were to give an example of Mindspace REIT, we distribute about 60% by way of dividend Around 30% comes by way of return of capital, and about 10% is by way of interest. Now, this could be different for different REITs depending on the capital structure of each individual REITs.
Okay.
But this is the form in which
the
you
broad
get,
framework.
yeah.
Now, viewers, please don't get confused and don't get worried if it's sounding a little too complex. The bottom line is that it's all very tax efficient, and definitely more tax efficient than most of the pure debt options out there, on which you largely have to pay flat tax at your slab rate. So, you know, the bottom line that our guests are making is that REITs could be very competitive from a tax efficiency point of view. We do have to take a quick break. On that note, we'll come back on the other side, and then we get down to the next level of analysis. How do you decide what's the right REIT for you? What should your investment time horizon be, and what are the avenues of investing in REITs? Back in just a moment.
Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we've put the spotlight on REITs, or real estate investment trusts, and why you should definitely read a bit more about them, listen to, of course, our conversation, and then decide, because they could be a good investment bet for you. Well, we've discussed some of the, the structuring, the taxation issues around REITs. Deepak, I wanted to now get down to the basic question of how to decide which REIT to be in. Like you're saying, there are 4 listed REITs, right? So what all should I consider, factors, before making that decision?
See, broadly, one is investors can invest in mutual funds who in turn take exposure to REIT in REIT. So professionals are doing that work for you. But any retail or HNI investor, when they are considering to invest in REIT directly, probably the factors to look in are, one, let's say, what is the occupancy level in that particular property? Who are the tenant profile of that particular property? Who is the sponsor? Whether the sponsor has given any guidance that they are likely to reduce their stake over a period of time. What is the who is the investment manager? What is the distribution yield which the REIT has paid over the course of last 1 year, and other valuation metrics as to at what discount it is trading to any REIT. Broadly, if these factors investors takes into account, and also based on, let's say, their readings as to whether they expect occupancy levels to increase. These are the multiple factors which probably an investor can consider while investing in a REIT.
Yeah, very interesting, and glad you brought this up, Deepak. Now, how much of this information, things like occupancy levels and, commitment of the sponsor, etc., how much of this is frequently publicly disclosed so that people can take an informed call, Preeti?
Right. So all of this information is available on a quarterly basis.
Okay.
So the results actually carry all of this information park-wise. So it's not just on a consolidated basis, but park-wise. And in fact, if you look at the disclosures that REIT make are so stringent, and therefore there's a whole lot of information available to investors to actually understand the assets, the location of the assets, what are the asset types. So like, for example, today you have 3 REITs which are office REIT, and there's 1 REIT which is a shopping center REIT.
Okay.
Tomorrow there could be more asset classes which can come in. So all this information is very well available on the websites. They are filed with the exchanges. Detailed asset-wise information is available.
Just one more quick point. The 4 listed REITs that we have, do they have very different sizes? Is there sort of some ballpark, average size across the industry? And from an investor's point of view, are you better off with a very large REIT that has investments in multiple properties? Or would you want to be in REITs which are more concentrated, say, the South market or the NCR market? How should an investor,
I think that's an individual choice. I think most of the REITs are giving diversification. There are 6 office markets if you look at office REITs in India. And I think most of the REITs are present in at least 3 or 4 office markets. Okay. So to that extent, there is a diversification available. But of course, each of the REITs have some presence which is a little more prominent in a particular market. So I think it's more to be, an individual decision, which market you want to be and which asset class you want to be. But otherwise, I would say that all the 4 REITs are well diversified across a couple of markets.
Now I'm coming to the issue of size, right? Yes. I mean, how big are big REITs? And then SEBI's also come out with a framework for small and medium REIts.
Correct.
So help us understand this. Small and medium, the nomenclature seems to indicate that should be good for small investors.
Right.
But that's not really the case, is it? Just explain that to us.
So a large REIT, the conventional mainstream REIT, allows you to make even investment in a unit. So say the units are $300, so you can actually invest just $300. Small and medium REITs, the whole idea to have them, today the investment in these were happening they were not regulated. You would have a manager who would pool money from a couple of
Informally,
HNIs,
yeah.
and pool that together and buy assets. And these assets could be, say, like one floor of a particular building or a small building, so to say. So SEBI has actually brought them under a regulatory framework and called them small and medium. But of course, the investment size is much larger. You'll have to invest 10 lakhs. So generally, these could be good for people who want to take exposure to a particular asset or to a particular micro market. And I don't want exposure beyond that. This is one. So those could be, and of course, the ticket size is much
10
larger.
lakhs. Your minimum investment is 10 lakhs.
Whereas in case of a mainstream REIT, you just invest one unit and then you get
350 rupees, whatever is the individual unit price.
So both have their own characteristics. It depends on who the investor is.
Got that. Okay, now let's talk about the mutual fund route. You can also access REITs via mutual funds. So Deepak, help us understand this. What kind of mutual funds invest in REITs, and do they largely look at investments in these big REITs, the large REITs? Or are mutual funds also now considering some investment in these new small and medium REITs? We only have a very few right now. I think just one or two, up and running as of now.
So basically, there are 4 listed REITs, and mutual funds currently have exposure to these 4 large REITs. Mutual funds can invest up to 10% of their portfolio in REIT and in REITs, and up to 5% of their exposure could be to a particular REIT or in REIT. So largely, mutual funds have an enabler in place where they can invest in REIT and REIT in their debt schemes, in their hybrid schemes, as well as few of mutual funds have also put an enabler in their equity schemes. So these are the 3 places where 3 schemes where mutual funds are taking REIT exposure. SME exposure opportunities have not been offered to institutional investors, but we will evaluate them. So let's say, just to give an example, and as Preeti mentioned, let's say in Mumbai market, there are office, let's say locality in Thana, let's say in Goregaon, BKC, Parel, Nariman Point. And let's say if we believe that GCCs are looking to open up spaces, let's say in Goregaon, and probably Goregaon market is likely to do better, then probably we will prefer REIT opportunities in that particular locality. So going ahead, right now the exposure is largely in the 4 large REITs, but going ahead we will evaluate opportunities in case we see merit in them.
All right, but obviously, I mean, the smaller REITs do carry more concentration and therefore slightly higher risk. Great conversation, very, very informative. But I want a quick 30-second wrap on this, Preeti. So remind us why all investors should definitely consider REITs as a part of their investment portfolio. What are the best features?
So I would say liquid, professionally managed, diversified instruments, ease of buying, selling, and with the moderate risk, moderate return profile, and giving you both stable income and growth.
Okay.
That's how I will sum it up.
All right. Thank you very much. Deepak, thank you for joining in as well. Like I said, it's been a very, very helpful conversation. Opens up a lot of new sort of ideas, food for thought in terms of looking at a brand new product in our investment portfolio as well. With that, it's a wrap on this edition. Keep sending us your feedback, comments, queries. Hope you found this conversation useful. We'll see you again with another theme next week.
Let's talk money